Hello, I'm Michael Browne from the Franklin Templeton Institute and welcome to the Macro Moments podcast. I am joined today by Stuart Kirk, the very well known, I'd say almost legendary author of Skin in the Game, the FT's chronicle, or Stuart's chronicle, of his travails with his pension fund and the objectives of being able to retire at 60. I think that's right.
Thanks for having me, Mike.
No, it's
pleasure.
a great pleasure to have you here. And Stuart's very kindly allowed us to have a look at his pension fund. And with that in mind, I've got with me Oliver Wallin from Franklin Templeton Investment Solutions, who has, I think in the old-fashioned sense, run the slide rule over the pension fund.
We've done a diagnostic, Mike.
Done a full diagnostic in the way we would do for any institutional portfolio. And we'll come to that in a little bit to see what risks Stuart's taking. Will he hit his objectives? Will it make the money that you want it to make? And obviously maybe discuss actually some of the changes that we could have on that. But first of all, just to kick things off a little bit, Stuart, 2026. I mean, this is the year that the dog didn't bark, isn't it? This is the year the world didn't break. I mean, what a 6 months that we've had. What's your thoughts?
Well, my thoughts is it's completely bonkers, really. For those of us, Mike and Ollie, of our particular age, I think all the tools that we have at our disposal and all the way we've learnt to look at equity markets and valuations are kind of out the window, aren't they? Multi-trillion-dollar IPOs at 90 times sales, $3 trillion worth of data centers being built over the next few years. Markets, some markets in particular, maybe twice as high as they should be by Kate ratios or Tobin's Q or any of these sort of real ones that we grew up in. Yet it still feels really, really bullish, doesn't it? I mean, it's beyond my comprehension. We almost need new ways of looking at how to look at these markets, which I'm sure we're going to discuss over the next hour.
And we thought that an oil price shock was coming through. We got our 70s textbooks out and looked at them and looked at the inflationary implications, and then nothing happened.
Yeah, and unlike in 99 where I also worked, I mean, every second article says that we're in a bubble. And, and there's like, we're in a bubble, we're in a bubble, we're in a bubble, and the market just doesn't seem to care, and we'll have a big down day and then a couple of up days. It's really quite extraordinary.
Yes, are we in a bubble, or are we just in a period where the world is changing completely, is the counter-argument. Let me just pick that thematic up, because we at Franklin Templeton do, I think it's something that's pretty unique actually. We survey all our portfolio managers twice a year, and we do little updates as well, but we survey them all twice a year as to their views as to markets. So we have I hate to use the phrase, but a hive mind approach here. We've got 82% response rate in this particular survey, so it is really strong and really indicative of that sort of view that we've got from the company. So let me just run through a few of the points that we've got from that as a scene setter, and we can debate around them. So the first thing is the US economy hasn't missed a beat. 2.5% growth is what we're looking for 2026. I suspect it'll be a little bit better than that, but the word is resilient. The employment market is resilient, notwithstanding the data yesterday, a little bit less than people thought, but that's okay, all right? PCE, inflation at the moment running at 3.3%. That's our estimate. It is running at about 3.3% at the moment. The Fed are estimating that. That feels like it's reasonably under control. I'm sure we'll come back and talk about that as well. And our view is Kevin Walsh is probably a hawk, but he's dressing up in very fine clothing at this moment in time. So in other words, we think the Fed might be on side of the investor from a medium point of view. That takes us to treasuries. We're looking at a range of 425 to 475. Obviously, we're bang in the middle of that at 445 at the present moment in time. S&P, interesting. Our estimates from portfolio managers are 7,400 to 7,800. That kind of gives you 4% upside from this particular moment in time. But that's not really the message. The message there is broadening and deepening. So the message is that they forecast at the beginning of the year the Mag 7 would underperform. Gosh, they have. I mean, they've actually lost a little bit of money year to date. We did say that. Now, the message is not dissimilar at this moment in time, but it's about that breadth that we're getting from the US economy and that breadth of earnings that is coming through. So that mid-cap and small cap area is, I think, really the focus that we would have at this moment in time. And you can see that in the earnings estimates as we're running into the second quarter. It's that's driving the upgrades for the S&P as a whole overall. And clearly the message there is buy the dips. in terms of the US economy. Bulls of Japan, still, I think is the phrase. We might come back to that one again. And of course, the EM markets, in particular the AI content. And obviously, again, the EM drive this year, the astonishing rates of returns, as you say, we've seen from Taiwan and Korea, are clearly influenced by the CapEx spend and the CapEx boom that we've got at this moment in time. Europe, we're a little bit different from most people. Obviously, since March, we've seen inflation expectations rise. We've seen a rate rise from the ECB. We've seen cuts in growth right across the board. Our PMs are not there. They're saying, no, I think Europe might surprise you to the upside. So it's not going to be 0.8, it's going to be 1.5. Now, a lot of people say, well, that's not a big difference. But in European terms, that's actually quite significant. And I think it's a directional pointer, which is quite interesting. It's cheap. It's only marginally above its long-term averages in terms of its valuation basis. And we would prefer large cap value, a classic kind of slightly defensive, let's edge into it. But there is obviously value there. And I think there's maybe a little momentum from our fund managers would say, a little momentum in Europe, which might catch people on surprise. What catches your eye out of that list, Stuart?
The first thing that caught my eye is how similar it is to my own view and my own portfolio, which is kind of worrying. Notwithstanding my zero weighting in Europe, and I'm much more underweight the US. The couple of things I'd say is, how excited can we be about a 1.5% growth rate in Europe? I mean, in an absolute sense, I think, even the US is 2.5% is probably what we all grew up with, right?
Which is 2.75 is the long average.
It's always something like that.
Yeah.
And it really is extraordinary. I mean, if you were a central bank governor or an alien being dropped down to earth and given these sort of macro boxes to fill in, you'd almost fill in the numbers that the US is exhibiting right now.
Yeah.
I guess one of the questions to my mind, if you step back and look at the US equity chart, for example, it's almost vertical. It's been almost vertical since late March. And it's very unusual you go from vertical to sort of sideways and up a bit. And if you look at that chart, it kind of goes vertical down, vertical down, vertical down. So I sort of slightly question your portfolio managers having a narrow band, which is sort of flat to up-ish. History doesn't tend to move in that direction. Otherwise, I'd be broadly sympathetic, I have to say.
Yeah, I mean, on the institute side, we do a lot of work in terms of looking at those pullbacks. And you normally get 2 or 3, 10 to 12% pullbacks in a year, which everybody panics about at that particular moment in time. I think we've obviously had one decent one this year. We're probably overdue one between now and September, October. And no doubt that will be based around some particular influence or something, but buy the dips.
Yeah.
So it's absolutely clear that we should be buying the dips. And maybe we can think a little bit about 27 actually in terms of where we're thinking on that. That's the view from Franklin Templeton. Now, Oliver, this is the moment where we put Stuart's portfolio under the microscope and where we have a look at it and see where the biases or unintended biases are and the opportunity set. And most importantly, can you get Stuart to retire at 60 with the pot that he wants?
Yeah. Okay. Thanks, Mike. And thank you very much for allowing us to have a look at your
Not at
portfolio,
all.
even though it's in the public realm. So I think when we start looking at a portfolio, it's always useful to remind ourselves of what the objective is on an ongoing basis. And apart from retiring comfortably at 60, the main objective you've put down is to hit an asset value of £1 million nominal by 2032. And we've got a current starting point of £700,000. And so our kickoff for this is, okay, to achieve that aim is a 6.1% annualized return, which is a pretty reasonable return target actually, and kind of justifies the current sort of risk positioning between equities and bonds. We think that's fully achievable, more than reasonable in fact. I mean, we've taken the portfolio as it currently stands with your existing weightings and put it through our portfolio management tool that incorporates our 10-year capital market expectations. So the returns that we have, return expectations and volatility expectations and the correlation for the next 10 years for a broad range of asset groups. Now, these are all forecasts, but the output was that the expected return from the portfolio as it stands is 7.46%, with an expected vol of 10.23 and not a bad ex-ante Sharp of 0.37. So pretty good marks for that. I think when we kind of look at that, and that is significantly better than our long-term expectations for just broad global all-world market indices, which is at 6.7% annualized for the next 10 years and a vol of about 12%. So looking at that, we'd be saying we're in a pretty good place here for achieving your objective. Your portfolio is geared up for achieving that. But if there is an option to do this just passively, just buying the global index, there is this sort of the next step is how much active weights do you actually need to put on your portfolio? So if you're chasing a much higher return, that justifies the kind of the larger country weight positions you have versus that index. But without that, you kind of question, well, you could just do this passively. So I guess my first sort of question to you in that is, what would be the challenge for you to not just buy the index? Where's the starting point for that?
Thanks, Ollie. That's really interesting. I mean, I'm guessing my portfolio comes up reasonably well because your own internal expectation numbers sort of mirror mine in terms of Asia and Japan and so on. So your expected return framework probably mirrors my portfolio, and I have big overweights in those areas.
Yep.
But yeah, so I mean, I started this portfolio, it was a little bit over 400,000. And when I first put my $1 million target out there for readers, it was a fun game to play. But back then, I think the returns I needed were closer to sort of 8.5, sort of almost pushing 9. And the response of most readers and myself indeed was, yeah, good luck with that. So it was definitely a nice challenge at the time, but a bumpy year last year in particular, thanks to the UK and Japan, has brought what I need before I'm 60 right down to around 6%. So I think you've cleverly raised the issue. What your portfolio doesn't need to be as racy as it is anymore. Yeah, that certainly underpins why I opened up a 20% position in fixed income, so I can sort of bag the 4.5% very easily. Thank you very much. But I think you're absolutely right as a criticism. It certainly doesn't need to be as racy as it is. Partly it's because I wouldn't have a huge amount to write about each week, as if I brought the risk profile down. If I was managing money for institutions like I was in my youth, it would be different again. But also fundamentally, I'm a value manager. And a lot of readers copy what I do and look to what I do. And I've written for many, many years and many years as an investor as well, like yourselves, believing that one shouldn't overpay. And the only markets that I can see that offer any reasonable amount of value where I don't look like a swivel-eyed lunatic are the ones where I'm heavily weighted. So that's UK, Japan, emerging markets, bits of Asia. Of course, parts of those are getting frothier. And you'll recall that there was a time where I went to zero in equities. After
you
that,
reversed that.
Yeah,
in the spring.
That looked very clever when it was a couple of days before the tariff announcements. I looked very clever. Then the markets rebounded again, and I looked increasingly silly. Then we had the Iran war, and it sort of all came out in the wash. But at least that was an internally consistent intellectual position, because I thought the US was overstretched. And if the US falls 30%, let's be honest, everything's going to fall, right?
Sure. Yeah.
So what I couldn't do is own everything but the US, because that's actually not internally logical, because if I genuinely think the US is going to fall, it would have taken everything
correlations
else with it.
are too high.
Yeah, the correlations are too high. So I had to have a small position in the US, otherwise I would just look silly. And that explains the 10% I have in the US, which basically is an indication of, yeah, you got to be in there. If I'm going to own any equities, you've got to own something in the US. I may be wrong about AI and valuations and so on. Maybe this is a moment where productivity goes through the roof and we get extraordinary GDP growth and the rest of it, hence the 10%, which allows me to own the other things. But yeah, I agree with your analysis, Ollie. It's too racy. The one justification I would have is if we convert all these numbers to real, 1 million when I set the target isn't 1 million when I'm 60. It's more like 800,000. So I would need more like 8 or 9%.
And we put these kind of market expectations forward just as a kind of a floor to give you some comfort and some framework on what to work on. I mean, these are 10-year numbers, obviously. I mean, you've got 6 years, so time's still on your side a little bit, still a friend. Yeah. But, we have to take that into account, that these are 10-year numbers and they are just forecasts.
No, and I thought the Sharpe ratio would have been much higher, to be honest. That's given me some comfort. I actually thought it was going to be much higher. Yeah.
But I think if we're looking at that and saying, well, this is the base case, then it's really about how we can steer the portfolio through short-term market movements, or whether we can sort of counter or take into account your own personal preferences, or just some key themes that you want to exploit over those next 4 years? But I bring it to note because it's the most obvious thing that stands out. And as an institutional investor, you're looking at your benchmark, your risk allocations versus that, and then you see, well, two things that I probably could do in my own portfolio would not be acceptable at an institutional level. One is big asset class swings to cash and back, mainly because you have to make two correct decisions for that to play out, and the probability starts to reduce significantly. So obviously that's why we create the bands.
I think you'd agree with that, Stuart, given your experience of going to cash and back.
Well, yeah, I'm in the more of the Andrew Smithers view on timing markets. I think it is possible. Most people think it isn't. I do think that market valuations in aggregate move around a mean in an upward direction.
Sure.
So you are probably better off holding and going to play golf. But I think around a mean upward trend, you can actually, if you're clever enough, sell and buy at the right time. And history seems to show that.
Yes. But I mean, I think from our perspective, it's just the room for error. The margin for error starts to get bigger the more decisions you make. And that's why we tend to operate on a sort of anchor benchmark and risk framework. Now, I mean, apart from the obvious, and we can talk about the weightings between that index and your own allocations, but I thought we ran this through more of our own kind of risk dashboards just to see whether there were any other intended or unintentional exposures. So I'm just going to go through those, talk those through, and we could decide whether that is by intent, whether it isn't, and if it isn't, what do we do about that? Do you still accept it, or do we try and offset that? So in terms of sector exposures, so country exposures aside, sector exposures, the largest ones are IT, financials, and industrials in that order. It's very hard to avoid IT exposure, certainly, but is that surprising to you? Have you, or is? And I'm not saying it's as big as the market.
I haven't wandered around thinking my second biggest exposure is financials, I have to say. But now that you say it, nodohoro, as they say in Japanese, now that you say it, it probably comes from my big weighting in the UK, I'm guessing. And likewise, on the IT side, I certainly didn't buy Asia originally 8 years ago to have massive AI, Samsung, SK Hynix exposure. I can tell you that. I'm grateful that I've got it, but I didn't originally set out. And sorry, what was the third one?
The third one was industrials.
Yeah, well, I guess that's what
kind
is
of
that?
Into LATAM and
that's
UK
probably a bit of LATAM and a bit of Asia, and
But does that make you uncomfortable at this point in time that you've got so much unintended exposure to AI at this point, and indeed into the banking system?
Because it goes against my underweight in the US, so that's internally inconsistent, isn't it? My underweight in the US and this sudden massive exposure to Asia AI.
But I mean, for us, it's a theme that we like, actually. So we looked at that and said, this is a theme that we're playing. It's a sort of a secondary link to the AI theme in that it is the supply side to feed. So you're still avoiding the direct impact of hyperscalers that dominate in the US. And so, we can totally understand that position. We talk about the bubble, you either think the bubble's going to expand out, there's still some momentum, you can identify it, but there's still further to go, which is kind of our position, or you want to avoid that entirely. And a direct sort of underweight US achieves that aim, but you can still enjoy that bubbles indirectly for this AI. And so we like that, but that wasn't your intentional.
No, and I'm just trying to think of the index in my head. If I would agree with you, but Mike, we'd probably get a broader exposure to AI through S&P 500 than you would through Asia.
At this point in time, yes.
So I agree with you, and I really only got 2 stock exposure, right?
Yeah,
because it's so concentrated, those indices.
Yes,
and you've still got your China piece, you've still got your India piece as well. So, but obviously that was half the index a couple of years ago. That shrunk really significantly. You got SK Hynix and Samsung dominating the Korean side, and obviously TSMC and friends dominating the Taiwanese side, and that's what's really driven that index, much to the good results of your portfolio over that period of time. So the question should be, is there a trade here that you're thinking about between, if you like, the people who have made the picks and shovels, if I can use that old analogy, for AI, which is what you've actually ended up investing in, and indeed the sort of longer term growth element that people talk about and obviously go to Asia to invest. Is there a trade there that you would think about at this point in time?
Probably right. I think that's one. And I also go back to the sort of mid-90s when the internet sort of popped up and you had the initial rise in the direct plays. But then as the internet was sort of incorporated into the logistics companies and the transport companies and retail and some of the industrials, it spread out quite quickly. And I think we're obviously going to go and we're going to see that again. The obvious beneficiaries being that next layer down in Asia and everywhere, probably.
Yeah.
One sort of corollary that I'm thinking about now is Japan, which I had a much bigger weight. I had 40% in Japan last year. Now I've only got, what have I got?
10?
Sort of
I think you're about
10.
Yeah.
And that's because after the Iran war, we had big sell-offs everywhere, didn't we?
Yeah.
But the Japan PE fell the least. And that's mostly because in these other markets, there were still rapid earnings upgrades. And so Japan, after the initial sell-off in March, looked the least attractive vis-a-vis the UK and Asia. So I only went, even though I'm a Japan lover, I have quite a small weighting there. But it's interesting that you'd think, therefore, okay, maybe I'll top up my Japan relative to some of these AI-heavy indices. But the earnings growth in places like the US and Asia has also been so bonkers that the valuations there still look pretty attractive.
I mean, we've also sort of tempered our Japan enthusiasm a little bit in recent months. I mean, we're never at the kind of overweight bands that you're prepared to operate in. But I mean, we've recently moved from an overweight for a neutral, and some of that is Iran driven because there is some sensitivity to the oil price within Japan, and that puts some pressure on earnings expectations. But then there's also this sense of sort of the deflationary impact, maybe what the policy is going to be doing. There's a little bit of uncertainty. So there's still a positivity looking at it.
And I have an unhedged fund,
waned.
and I had to take a call on the yen, which was the right one.
Absolutely.
So if you actually look at the performance of my fund versus the index, for a domestic investor, it's very different.
Yeah.
And that's one thing we should say. I mean, I guess most of the audience listening to this is institutional, but mine is a retail portfolio for somebody sitting in England with pound liabilities.
And it is quite clear that the conversation is now on the table about the level of the yen, about interest rates, about what level of inflation can they tolerate in Japan, because as we know, there isn't the same mechanism for passing inflation through the wage system to get back your loss of real wages as exists, say, for instance, in Europe. So that there is a real deflationary element to inflation at this particular point in time.
And the other reason I like Japan is the sort of heads you win, tails you element to it, and a little bit like, well, I bought my first apartment in New York on the back of the yen rapidly rebounding during the financial crisis. And if there is a massive explosion out there, I do believe the yen will outperform other currencies. So I either get the benefit of the stock market going up as the yen depreciates, because they're still predominantly exporters, and if the world blows up, I would expect a huge correction in the yen, and I've got an exposure there as well.
I might sort of continue on with the sort of other layers of exposures, and then we can touch on some of the more thematic bets that you put on. But we looked. There is definitely a weighting towards early cyclicals within your portfolio rather than sort of late cyclicals and defensive. Is that is sort of intentional view that we are into sort of emerging, because this would be a kind of, we're emerging from a period of recession, and we're moving into a more sort of early growth period and the associated companies with that?
Yeah, I think if you believe the CapEx story, if you believe the AI story, then we are at the beginning of whatever's coming. And I 55-60% believe it. I think, there's been quite a few, this time it's different in our career, but I think AI is, if it's going to be anything that gets productivity surging again for the first time in 15, 20 years, this will be the technology that does it. Therefore, I would rather have early cyclicals than have any more of a defensive stance. I think that's also internally consistent.
I think if I remember, I was going to say, one of the things that we've noticed, obviously, is you ratcheted up the investment numbers for the 4 hyperscalers in the US and current. I think official estimates are about 600 billion now, and we started the year at 500 billion, and actually, really, it's probably more like 700 billion that we're going to see. But the flip side, the rest of the market is expected to do just under about 950 billion, and that was about a 4% growth at the beginning. Now that doesn't feel right. I mean, obviously there's tax incentives in the US at this point in time, and that 4% figure just for an economy that's beginning to motor feels too low. And that's one of the elements that we're looking at and thinking of, that this is a sort of secondary driver, because clearly corporate balance sheets on the broader America is really good, are in good shape. If the earnings growth is picking up, we're going to see more investment on the widest possible element of the economy. So that early cyclical position, I think, would be one that would clearly should benefit at that moment in time.
Yeah. And I think that's what's driving the earnings growth as well. And I have to say, I think this discussion that there's some sort of equivalence between an earnings bubble and a price bubble is a little bit nonsensical. I mean, a price bubble is a bunch of meme investors and crazy retail people overpaying for stuff. I mean, I've run research at Deutsche on research content on the sell side, and earnings upgrades come bottom up from smart people crunching the numbers, putting them into a spreadsheet, aggregating them, releasing the numbers. It's not the same as a price bubble. And so, okay, sure, there's an acceleration and earnings growth is growing faster than we've ever seen in a very, very long time. Some of the numbers now are just off the charts. Yep. But that's not just a bunch of crazies picking a number out of thin air. Yeah. Okay, companies may miss. Fine, they may miss. But, these are built bottom up.
This is the aggregate wisdom of a lot of very intelligent people.
I agree with that wholeheartedly.
Can get it wrong, but they're not the same thing.
And we might look at that as saying, well, that's why a horrible phrase, but this time it's different. If you're going to allude back to the internet 90s kind of bubble, where you're in a different position where the actual earnings do look sound, and the projections do look sound, and the expectations of that business model do look sound. There are profits being earned despite the hype and the story.
And I think there's an intellectual fallacy as well on people who 3-5 years ago complained that corporate America or CEOs don't invest enough, and are now complaining that they're investing too much. Now, as an investor, as an equity investor, if the hyperscalers turn off the CapEx spigots, it's more cash flow for me. Yeah. Like it's not the end of the world. There may be some companies out there that don't like it, but you can't have it both ways. You want the right level of CapEx to match the growth expectations, and that's why, as an analyst, the first thing you should look at, and I've always looked at and trained analysts to look at, is CapEx to sales ratios. You want a CapEx to sale ratio to be reasonably steady, and you want that CapEx to fund future growth. And the only reason these guys are investing is they can see the growth and they can see the demand and the demand for compute. And my mum hasn't even started using AI yet. There are lots of people who haven't. The demand is there. And even if it isn't there, I will get, as an equity holder, I will get the cash flows when they just dial it down a little bit anyway.
Yeah. And that's the unusual thing about this particular industrial revolution, if I can use the phrase, is that it's primarily funded from cash flow.
Yeah, there's more debt now than there was, but it's still...
But it's still relatively to previous... building out a load of railroads with a load of debt in a railroad company with no passengers yet because they haven't paid a fare, that's debt, right? Yeah. This is, let's take this cash flow and let's use it in this particular area. And even now, the cash flow numbers are suggesting that the hyperscalers will only just be flat this year, which is it's an astonishing figure in historical terms. Yeah. But this is why we're thinking about that broader, that mid and smaller part of the market, because this is a wave that deepens and broadens at this point in time. And I think your point about corporates have underinvested for a long time is something we can see reflected. You can see in social trends, you can see it in political trends, you can see it right across the board, and that presumably you get to a point where the rates of return that you get from making some of those investments at this point in time are significantly higher and worth doing, which then drives the overall earnings base for the wider market rather than just the narrow part. Yeah.
And I've written about this a lot when I was in research at Deutsche and HSBC and elsewhere, that because real wage growth was so low, because rates were so low, tax rates were fairly steady, margin growth came fairly easily for companies. I mean, my dog could run an S&P 500 company in that sort of late 90s to 2015 period. Margins just kept going up and up and up, and that drove ROE expansion. There was no leverage increase, and there was no asset turn increase. So ROE was being driven by margins. So companies didn't really reinvest. They didn't buy the newest kit. They didn't need to, but now they are. And I think that's really, really positive for both margins and then by implication ROEs.
Yeah, so I'm in agreement with that, and that's kind of our base case for believing that there is still some way to go for this sort of AI story and the theme, and there are different ways to play it. And obviously within your portfolio and the use of ETFs, it's a fairly blunt instrument in how you can kind of tighten up your portfolio exposures. I mean, we've looked again, we can see that the portfolio, quite obviously, given some of the indices that you're accessing, like FTSE 100 is market cap, it's size weighted. Within that, there's definitely a leaning towards growth and momentum over sort of value and quality, which, I mean, these are just naming conventions within our sort of risk profiling tool, but it feels that that's slightly counter to where your initial stance of being a value investor might be. Any views on that particular thing? I mean, there's not a huge amount you can do about it. Obviously,
I'd need to see the numbers, but I wonder
and
what your system calls growth within a cheap market like the UK compares to value in a more expensive market. If they're if they're still relatively cheap, I wouldn't mind, but it does make me want to go away and see if I've genuinely got too much growth in FTSE 100, then I might want to look at that. My guess is that they probably aren't that expensive, given the weight to banks. Maybe some of the oil and gas companies have got a little bit expensive. I don't know. Financials is an interesting one because my instinct tells me rates aren't going to go much higher. My natural inclination is that for various structural factors, they should probably stay low, demographics, all the rest of it. AI's got to be deflationary, doesn't it, ultimately?
There might be an inflationary bump as we're chasing
ultimately,
kit, but yes.
None of us are going to ask a pay rise over the next, I mean, it's not going to happen. So that would go against the idea of net interest margins rising for financials, for example. I do think there's probably a 20-year play converting retail customers to wealth customers, which is all good for people in this room. And the big banks, the JP Morgans are doing it, the HSBCs and so on, Lloyds's. But if I do think rates are going lower, my exposure to financials perhaps is too high. Yeah. Thanks for pointing that out.
Well, I mean, this is all terminology as well. I mean, this is just a flag up to assess whether you have a definite style preference that you're trying to implement in your portfolio and whether that is actually being reflected in the choice of the instruments that you have now.
I think the answer is no, because I don't have access to the tools like you have anymore. I don't have Barra and all those sort of things that I used to have. I tend to make geographic calls based on relatively simple valuation metrics rather than go down the factor or style route.
Yeah,
probably should do, because it will open up a whole weeks and weeks and weeks of columns.
I think it will. We're definitely not judging on that, but I mean, it's fully understood. But obviously, there are instruments out there in the passive and ETF world that you could actively up your growth,
you can buy these factors in, right?
Absolutely,
and everything else. And but then you're stepping into a different level of active management beyond your sort of regional bits. But I think it just helps you get a kind of picture. But I mean, given we're talking about the regional allocations, how much heavy lifting these actually have to do in your active weights or are doing, I should say. I mean, they've taken your portfolio to a pretty good place after the past few years that you're allowed to have a lower return expectation in nominal terms. So the challenge that I'm looking at that is, and I've said it before and mentioned it, do you really need to take as much active risk in the portfolio as you currently are from our perspective to achieve your aims? Now, we can definitely have different views about the prospects for economies around the globe. We're not always investing in those economies through the ETFs that we're accessing or the indices that we're accessing. But I think that there are two standouts, and we've touched on it, but probably worth expanding on just to get it straight. Obviously, for us, we understand the underweight US, but the extent of that underweight we feel is kind of excessive, or I feel is kind of, it would make me a little bit nervous. But if the understanding of the rationale is because it's making relative positions to the global index, obviously, so we have to take it away from somewhere else and put it somewhere. It feels that some of the positions in your portfolio, notably UK and LATAM, we'll get the EM Asia out of the way, is is a conscious bet to steer away from the US for the exposure to the hyperscalers, to a kind of an over-reliance on that AI theme. So that's the intention. So our starter for 10 for you, Stuart, is the UK the only place that you could do it? I mean, our view is that's one way to do it, but it's a very narrow way to do it. And maybe there's other options for you
I
to
can see where you're going here.
expand.
Does it start with an E, then a U, then an R, and an O, and a P?
It kind of does do, and I think but I think that, and I'll lay that out. I'm taking you through the side door there, but I think it's because we can have a view on the EU economy, but we can also have a different view on the companies that sit within that index, and that there is an advantage in accessing the EU in our mind to broaden the sectors that you're in. So to get greater exposure to luxury goods, to defence, to consumer discretionary that you can't find in that UK narrow band. So it performs one function. So it would be good just to talk about potentially why you're against that.
Now, there's probably an inbuilt prejudice. I have to admit. I mean, my boss took me aside on my first day at work in 1995 when I started at Morgan Grenfell Asset Management and said, never underweight the US and never overweight Europe, and it sort of stuck with me for the whole time. And he's basically, if I'd just done those two things, I would have retired. So on the one side of that, I've probably always been too underweight the US. Just because I always think the valuation's too high, and it's always proved right, and I've always been wrong. And on the other side, I've mostly been right about Europe, and the prejudice comes from meeting millions of managers who just don't quite care about equity holders as much as US or Anglo-Saxon or Australian or UK CEOs do. And then, of course, all the boring litany of regulation, and they're just not the kind of capitalist monsters that the US is. And I think that's still broadly right. Now, is that sort of in the price? Probably. Am I being prejudicial? Probably. It probably pays to stock pick in Europe more, given that. Which do I have the time to do? Maybe not. But I certainly think my gut feeling, hearing you say it again, is that it's too much prejudice and not enough intellect on my half, and I should probably look to do a proper deep dive on Europe again, because it's big. There's lots of people, 900 million of them, and you can't write everything off. And you've spent most of your life doing Europe, right? You probably tell me there's lots of really good companies that care about shareholders.
Isn't there a case that it's just about understanding why you're doing it? I mean, you can go into that market and hold your nose a little bit and say, well, I'm here for defence exposure. I'm here for a breadth that I can't get in the UK. I'm still achieving my US underweight, but I'm not embracing the European story wholeheartedly.
Well, the question I'd fire back at you is, where would I fund it from, given my portfolio, right? So I've got LATAM on like 9 times. I was trying to work out the properly adjusted abnormal forward PEs. I came up with, single-digit number for LATAM. UK still 12-ish or something like that. Asia, I've got down from 20 to 12. Japan, not quite so good, 15. Long-term average 16, maybe. But I don't have a huge amount in Japan anymore. And US is still pretty small. I guess your answer might be UK. Is that my biggest?
I mean, so the UK.
So broaden UK out into Europe.
And this is what the motivation is about. So
follow the politics. We're embracing Europe. We're back in Europe.
It's there to definitely. I mean, it's to fund from the UK, because when we're looking at the size of the exposure and the narrowness of the market and the sort of the bet that you're placing on the UK FTSE 100 specifically to outperform, which isn't necessarily linked to the UK economy, but there will be a benefit in the FTSE 100 if we have a super dovish Bank of England, but that's whether you
I also bought it for the oil and gas.
Yes, and so you have it
but
for the energy.
This is the thing about the UK, isn't it? The UK market is this strange, very global, actually very early cycle trade. It's about buying oil and gas, which obviously picks up when people got more demand for energy. It's about buying the miners
and it's
and
a
the
little
metal
bit like
stocks.
Japan as
again,
well.
Same again early
If the government blows up the pound, I'm great.
It doesn't matter.
I love it. Bring it on.
Yeah, and obviously you've got your banks there again, which tend to be early cycle rather than late cycle. Your farmers are your defensive part of it. But that brings me to the other side, that UK has, without doubt, in the last 6 or 7 years been the defensive asset of choice. It's been the one thing. If everything's going wrong elsewhere, the UK market's been the one that's held up and has given you this extraordinary defensive position. And quite often I say to people, you cannot be underweight the UK for exactly that reason. But that's what's giving your early cyclical. That's what's giving you your early part into that economy. And obviously, the European side, with its consumer bias, is going to take you into a more mid or later part. In particular, there's a strong Chinese bias in the luxury goods area as well. Is that a direction you would feel comfortable at this point in time?
Yeah. Yes, I think is the answer. And I would add the one risk for the UK that no one really talks about, but we talk about every 10 years or so, is if this housing slowdown or property price slowdown continues, given the weight of banks, a good old-fashioned sort of 1991 style, 2008 housing correction would be problematic for the UK in my portfolio, I think. But no, I agree with you. I just don't feel I have the skill set to sort of broaden into Europe, and short of just shutting my eyes. I mean, my question would be, would you add a European fund, or would you do a pan-UK European fund? I don't really know how the weightings work in those indices.
Yeah, so that, I think our view for this would be, just in keeping with the way the portfolio is structured now, a broad European index at least gives you some exposure, because the direction of travel here, or the motivation for moving there from UK, is just to breadthen the exposure beyond energy companies, beyond the global growth story. And
would it improve my Sharpe ratio if I took money out of the UK and put it in Europe based on your systems?
So that's
what's your outlook for?
So on an ex-ante basis, it might not do, because we're looking. We're looking at two blunt instruments, which is the return.
I'm just wondering what your return and expectations are for Europe versus the UK.
A good challenge, which I should have in my head, but I don't. But we can provide that and run it through on that basis. But the challenge is merely just to broaden that exposure.
Because in your survey that I read, I saw the GDP growth forecast, but I didn't see the equity forecast for Europe.
So I should have mentioned that. So we think that the equity returns for Europe will be in line with its earnings growth, and the earnings growth we're looking at about 7.5–8%. So, some markets have done that this year, but if I look at the Germans and the French, they very clearly haven't at this particular point in time, and the UK is lagging those sorts of figures. But then what that's saying to me is that we've got a market that's not changing its valuation this particular year. Its upside is not that dissimilar from 7,800 on the S&P. So we're looking at that 4%, maybe a little bit more in Europe, degree of upside. So what I would suggest, Stuart, is you've probably got time on your side to make a decision as to whether or not you want to bring that breadth in at this particular moment in time, especially as I think we're all discussing that this is a resilient economy. There's sort of elements of early cycle that seem to be bubbling away here at this moment in time. So there's no rush here. But what it does do, and I think all of that focus does do, is bring out the question of what does 27 look like? And I think as we go through now the next few months, I think that's going to be a really important question, because I think elements of our investment now must be focused on the end of 27. And right now, sitting here, my guts tell me that 27 could be actually a very decent GDP year, but does that put a little bit more pressure on the inflationary side?
And I look at the valuations of some of the defence companies in Europe, and I don't really want to touch them. And if you wake up on January the 1st and peace breaks out in Ukraine or whatever, they're going to fall. I think about that as well. But we've got time, I think, to think about that.
That's a subject. That's a subject for a very different podcast.
It's a sackable offence at the FT to end an article with "time will tell." But
but I think in terms of that, that positioning, when we agree with the underweight position. Absolutely. If we were looking at the portfolio, and we're just now talking about the scale of the underweight, and where we're looking at what a benchmark can deliver. And I know you haven't constructed this portfolio around a benchmark, but I think it might be a valuable tool. Sure. Now that we don't know for sure, but there's a kind of reasonable expectation that you can get to where you want to on your objective.
That's
by
fabulous.
Doing less active investment.
It's a lonely place I inhabit. If it goes wrong when I buy Europe, I know who to call.
Ollie, there's one more question here. It's the 80-20 split. So you've got 18% in gilts. Let's call it 80-20 to make it easy. What's your thoughts on that?
I think our first point of view is it's a pretty reasonable exposure given where we are in the cycle, and even given your return expectations, a good opportunistic investment. From an institutional perspective, you're looking at that saying that's targeting one very specific point on the yield curve, only one specific piece of duration, which is kind of an elevated risk ultimately. And so I think when we're looking at that, I mean, it still works, but just thinking 18% feels a little bit high, and that there's an opportunity maybe to diversify that duration a little bit. But I know that you've gone in there on a very opportunistic place.
Yeah, I mean, it's sold off.
Yeah,
I like the yield.
And you don't
my
like balanced
expectation. Yeah,
portfolios.
my goal had been reduced to 6%. I thought I'll lock that 4.5 in, and worry about the rest later.
Yeah, but it feels the outcome is fairly sensible on a 6-year time frame with a 6.1% return target. It's not going to be a drag. It's not a drag.
Yeah, and I think that long-term expectations for inflation at the moment, according to the Bank of England, is 3.4%. So you're comfortably in real rates of return here. I think the long-term mean and median average is 3.6% since GFC, which is interesting that if you like, the general public have clocked it, they've got it. Right, but again, you're getting quite a decent real rate of return on that particular gilt at this particular moment in time. Obviously, there'll be a bit of in that duration risk. There's a bit of political risk. I don't want to say too much about that, but there obviously must be. And we've had 10 years of political risk, so clearly there must be something in that as well. And Ollie, you would just like to see that duration shortened a little bit.
Well, just diversified. I think when you're just targeting one particular point. I mean, it's just unusual to look at that. One point on the curve.
Yeah, absolutely.
But we totally understand why you're there.
So, Ollie, now I have to ask you, marks out of 10 for Stuart's portfolio.
Well, I think when you sit there and say what you've achieved to date to allow you to be targeting 6.1%, I think it's pretty good. Obviously, that's in not in real terms. But you have room to up the risk, don't you, and try and achieve a higher return. Generally, we're looking at some of the scale of the exposures. The question would be, do you really need to take as much risk to achieve your aim? And that's where we're just talking about narrowing what we mean by underweight and overweight exposures relative to a global index that actually is going to take you potentially where you want to get to. And then it's really, then we're sitting there going, how much do you dislike this hyperscaler story? How many of these decisions are being made? Like the LATAM position feels like just an asymmetric bet against the US. I've just got to be away from the hyperscaler exposure. And is that the most efficient way? And we will get back to Europe. I think that there is this option to just broaden out what you're doing in the UK to include a little bit of Europe. If it's more palatable to do a pan-Europe for you so that you don't have to take those bets. But it feels that you want to do that separately because you want to keep that control of exposure to the UK and not surrender that asset allocation lever. But I reckon it's...
Thanks very much for doing that. I appreciate it.
Now, we've had a lot of questions.
Yep.
And not surprisingly, given how well read your column is, and I'm going to just pick a couple of these questions and see how we go over time.
I'll try to answer.
All right. Several of them came in on the same sort of theme, and I think this one actually really brought that together. So, given the uncertainty around inflation and growth and geopolitics and fiscal policy and the AI capital expenditure, which macro assumption do you think investors are most likely to underestimate for the second half of this year? And I'm going to push that horizon out a bit. You can have the whole of 27 as well.
All right. Well, one way to answer that is I spent a lot of my life going through macro variables and other things that don't matter or shouldn't matter for investors. And most of them are listed there. Plenty of academic papers and data will show you geopolitics almost makes no difference whatsoever. Interest rates basically make no difference absolutely whatsoever. What were the other ones on there? Inflation.
We've got inflation, growth, fiscal policy, AI.
Tax doesn't make any difference at all. Inflation only at the margin, and you should be in equities anyway. So most of these things that the reader has asked is it a risk? I would say is not a risk. And at the end of that question, they said, well, what macro stuff would you look at? I think debt. Debt is really the only thing. Before every really big sell-off, there has been a massive amount of debt relative to GDP or anything else, and a huge and rapid spike in policy rates.
Yes. I've written a paper on this, and I could not agree.
So in general, long-term rate doesn't matter, but when you get a steep and rapid 2, 3, 4, 800 basis points, then everything changes
But Stuart,
very quickly.
I
Would you
went
agree?
back and looked at every bubble,
Yeah.
right? And even back to 1637.
Yeah.
And in every single
Yeah.
bubble, interest rates were
Yeah.
rising for at least 12
we're
months
nowhere near that.
before the peak.
We're nowhere near that now, right?
And miles before the
Yeah.
peak. So, yeah, debt and rates rising are clear long-term indicators that
And
something
none
is
of those
something's
are
gonna go
flashing
wrong.
red, are they?
And
Right?
none of those are flashing red. So you'd say, look at the level of debt, look at the level of interest
Yeah,
rates,
ignore everything else.
and that then, of course, covers whether it's corporate or whether it's government debt. You're not that concerned either which way round. That's your key marker going forward. Ollie, would you agree with that?
I would, yeah. But it's also sort of add in from an investor's perspective, just an ongoing willingness and optimism amongst equity investors to try and look through any short-term macro events. Everything that I hear is always, we're looking through those short-term events for the longer-term fundamentals, and that can blindside you if you're too overly optimistic on that level.
Now, picking up on the optimism note, another question, really going to this sort of
Yeah.
sense of why is the investment community always optimistic, right? So yes, we're looking at the macro, we can see, on this hand or on that hand, and the macro backdrop, as the writer puts, genuinely uncertain. Why does the conclusion always seem to be stay the course?
Well, I think there are two answers. One, I'm not trying to be cute, but when you're in the asset gathering business, we have a natural inclination to be bullish, as opposed to being a sort of neutral academic. We are, our natural position as asset managers should be things are going to go up, as opposed to being on the sell side when I could make a bit more radical calls. But if you put up any equity chart and you stand back and you have a look at it, there's a reason for that.
Yep.
And they go up.
Yep.
And anyone who's tried to short for a long period of time, or any strategist that I've ever hired who's trying to make a name for themselves by going short, doesn't last very long in this business because equities go up.
I mean, I think if I'm right, the long-term real returns for the US, something like 6.6% over 125 years. I mean, that is the impact of compounding on that is just mind-blowing from that perspective. Would you agree with that?
I would be the person who's sitting there going, yes, hold out, stay invested, stay in the market. And I think the main driver of that is just an understanding that as a more institutional investor or someone who's managing money on another person's behalf, you've kind of got a different time frame. So it's like who is talking, what is their time frame? We always have the comfort of looking at 10 years plus time frame. That allows us to fall back on longer term assumptions, be a little bit more comfortable, be a little bit more optimistic. I think that's a key part. I think it's about understanding that we're working on broader objectives. And in many ways, we have to look through some of the short-term noise. I mean, we can, and we're constantly hearing that the macro events are putting short-term pressures. But this is about how we inform adjustments to our longer-term expectations, our longer-term structure, because that's what we're looking to, and that's what we're paid to do. So it may be more exciting to shout about how poorly the macro environment is, but our view is, okay, well, how's that going to affect our longer-term direction of travel? Is it going to affect it significantly? Is there anything we can do in the short term to adjust for that? So that's why I'm feeling more comfortable. I don't think it's bad to say, hold on tight.
Yeah, in other words, the downside isn't that great, and the upside, I'm afraid, infinitesimal. And that's just the maths of the situation. It's just pure maths. Would you say that to a 75-year-old, though, Stuart? Because your columns have this great debate. Stay in equities, absolutely, until you get to retirement age. But is there a point where you would change that? And, of course, that brings in the whole conversation about DB and direct and benefit and direct contribution pension funds.
Yeah, and I think the argument around it is changing a lot since we were a pup. In the olden days, you would get a 55, 65-year-old much more heavily or sooner into bonds than now.
Yes.
People are living longer. The volatility around equities is often a lot less than on fixed income. And so we tend to have higher allocations to equities given a certain age than we used to. But it is also absolutely true if you were just about to start investing a wad of cash, you put it in and the market suddenly corrected 15% and you were dollar cost ravaged and until your ears hurt, it would be very, very painful. It would take you a long time to get that back. But there's nothing you can do about that ex ante, I'm afraid, to know when that is. And given the volatility in some of these markets at the moment, knowing when to dip your toe in for the first time does feel, but you've just got to just do it.
And you went straight in, didn't you?
I
You
know.
went from cash to a portfolio.
So when I went back, I just sort of, as a boss used to say when I used to run Japanese equities, I'm going to go to the pub, get drunk, and buy Sonny. Sometimes you've just got to go and have a long lunch and then go and press the button.
A local question. Okay, so how seriously should investors take UK political risk over the next few quarters? Whether that is leadership uncertainty, looser fiscal stance, or the gilt markets testing the Labour Party's fiscal credibility?
Yeah, well, I've written about this a lot as well. Why do we all think that bond investors are so intelligent or more intelligent than equity investors? They get things completely wrong as well. And at some part of me feels sympathy from the Burnham. You know, sometimes you've got to stand up to these guys. On the other side, read everything I've said about geopolitics not mattering and all of that sort of stuff. Then we mentioned earlier in the hour about how you're sort of hedged in the UK as well. So if governments stuff this up and there's a bit of a run on the pound, the FTSE 100 will absolutely love it. They make most of their money outside of the UK. Yeah. So I feel reasonably comfortable where I am from a political standpoint. Now, can debt go up for absolutely ever? I said no 20 years ago, and I said no 15 years ago, and I said, I've been wrong about been wrong about that for a very long time. But I still think there will be a limit for government debt to GDP. Don't know when that is, but it's sooner than it was 5 years ago and sooner than it was 10 years ago. But I think owning, particularly the FTSE, you're relatively
safe.
Yeah.
Ollie, how would you look at that?
I have nothing more really to add from where Stuart is. There's a difference between the economy and the index that you're investing in, and that's the most important distinction. There are other factors at play that are going to reward your investment in that strategy. We still look from a global perspective at the UK market as a very defensive market, and it's there for a purpose. Is it the best defensive market at the moment? Is it even the best market to benefit from sort of energy boosts? I mean, we're not even questioning that. It might be Canada as a better place to be relative to the UK. But yeah, I think we're definitely observing it. That's what it is. It's a narrow defensive market, and it serves a purpose in a portfolio. At the moment, it's not a place that we are. I think we're slightly underweight.
I'm going to thump the tub in a slightly different direction.
Yeah,
it is clear since Brexit, if you look at spreads in the UK debt markets vis-a-vis Germany and the rest of Europe, that spreads have widened by a good 100 basis points over that period of time. So if you could get control of the situation, there is a clear premium that could disappear. There's a clear opportunity set. Might help your gilts holding.
I completely agree. I think the risk is the other way.
So that if you can get hold of it, there is a clear premium of lower rates that is sitting there as an opportunity in the UK relative to Europe, relative to normalized spreads. And of course, that then reflects back to the inflation figure, which I gave earlier. It's sort of 3.6% averaging since over almost 20 years now. Again, if that could drop a little bit to the 2.5% level at this point in time, then you'll be getting that premium squeezed further. Couple of things about UK mid-caps, which have been a difficult place to be over the last few years because rates have been high and they've been being held up there. The UK is clearly, on a European basis, still an AI innovator. I'm told that we've produced more unicorns than the rest of Europe put together, which is a remarkable stat. What I do know is looking at the private equity investments, that the UK has received more AI investments over the last decade than, frankly, the whole of Europe put together as well. But in comparison to the US, it's very, very small.
And last time I looked, the cash flow return on investment to some of these mid-caps, UK stocks, biotech, blah, 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 is really high.
Yeah, so I think there's value there. I think there is some real innovation there. I think there is actually an economy that's clearly functioning, although everybody wants to claim it doesn't. So I'm going to tub thump slightly in the other direction and say there's an opportunity set here, whether it's today or whether it's tomorrow, I don't know. But it's going to come through. And on that worryingly optimistic note about the UK, or at least the opportunity set, I'm going to have to wrap us up. That's been an hour that has literally flown by. Stuart, thank you very much indeed.
Thank you very much for having me. No, not at all.
Exposing yourself to Ollie and all his algorithms that are working away in the background. And thank you, Ollie, for doing the work on that side. I hope that everybody's found this conversation interesting. I have. I've really enjoyed it. In fact, I've enjoyed it so much, we've got some more questions. So there'll be a bit of a bonus podcast edition for anybody who wants to come and look at us on every podcast forum that we are going to have, because we are going to go out on that. So you'll be a little bit extra. So if you don't mind, we'll stay and do a little bit more. I look forward to seeing Ollie, you back again, and maybe Stuart, you'll even come back and be a friend of the cast some stage in the future.
My first podcast. Thank you.
But thank you very much indeed, everybody. Thank you, everybody, for watching and sending in amazing questions. And see you again soon.